Hey guys, welcome back to another video. In the previous videos, we discussed three main patterns. Let's talk about how you can actually use triangles, channels, and wedges in your trading strategy. Let's dive in. The key to trading triangles, wedges, and channels is to follow the direction in which the pattern breaks. This can apply to any of the patterns we just went over. If the breakout is to the upside, you'd look to trade in that direction. If it breaks to the downside, you'd trade accordingly. Let's break down the different strategy setups. We'll begin with the first, spotting a trend, then identifying a pattern forming, and finally waiting for a breakout that continues in the direction of the original trend. This is what we call a trend continuation strategy. Here's an example with Tesla's chart. You'll notice an upward trend leading into a descending triangle setup. Just to clarify, any of the patterns we discussed could have appeared here. But in this case, it's a descending triangle. If the price breaks above that triangle, it's a signal that the trend is continuing upward. That breakout takes bullish strength, creating a new high. At that point, you'd start taking long trades on shorter intraday timeframes since the trend is now confirmed. Here's another one, Ethereum. The chart shows an uptrend first, followed by a descending channel. Again, this could have been any pattern from our list, but here we see a descending channel. If the price then breaks upward, you'd enter long trades in the lower timeframes, riding the trend continuation. This strategy works in a downtrend too. Take a downward trend where a descending triangle forms. Again, any of the patterns could apply, but here we have a descending triangle. If the price breaks below the pattern, continuing the direction of the downtrend, you'd then take short trades following that trend lower. Now let's move on to another setup. Spotting a trend, seeing a pattern form, and then watching that pattern break in the opposite direction of the overall trend. This signals a reversal strategy. For example, you might have a clear upward trend that leads into the formation of an ascending triangle. It could be any chart pattern from the common list, but in this case, it's an ascending triangle. Eventually, the pattern breaks downward, which goes against the original uptrend. This break indicates a possible reversal, meaning the trend is shifting from up to down. At this point, you'd be looking to take short positions once the price breaks below the pattern. Now, flipping this around in a downtrend, the idea works the same way. Let's say you're in a downward trend and a falling wedge pattern starts forming. Again, it could be any of the common patterns, but in this scenario, it's a falling wedge. When the pattern breaks to the upside against the main downtrend, it suggests a potential reversal, this time from a downtrend to an uptrend. So you'd start looking for long entries once the price breaks out upwards. Now let's explore another variation. Recognizing a trend, spotting a pattern, and seeing a breakout in the same direction as the trend. But instead of entering on the breakout itself, this method waits for a pullback. This is a trend continuation strategy. Using Microsoft stock as an example, suppose there's a strong uptrend followed by an ascending triangle forming. Again, while it could be any pattern, here it's the ascending triangle. As shown before, once the price breaks above the pattern, a breakout entry would be valid. However, more cautious traders prefer to wait for a pullback before entering. That pullback often shows up as multiple candles with long wicks reacting to the newly formed support near the top edge of the triangle, and where a moving average also aligns, creating a strong confluence zone. Once there's a shift in the lower time frame trend, that's when you'd look to take long trades using your strategy and tools. Whether you go for a breakout entry or wait for the pullback, both approaches are valid. It really depends on your trading style. Remember that stop-loss placement is different for breakout versus pullback entries, and that's something we'll cover in detail later on. If you like this video, make sure to give us a thumbs up. And don't forget to subscribe and press the bell icon. That's it for today. See you next time.